So appreciate everybody taking the time to join today and appreciate everyone who was able to take the poll. I know that a Thursday afternoon is competing with like six other things on your calendar, so I do appreciate everybody carving out the time. My name's Seth Koller. I'm with BlastPoint, and for the next 45 minutes, I want to spend some time walking you through something that we've been sitting on for several weeks now. Basically, what we did was pull Q1 2026 NCUA call report data, every single credit union in the country, north of 4,300 of them, and took pause to ask a very simple question. What did the fastest growing credit unions actually do differently than everybody else of their size? Now, just to level set, we're not comparing the $10 billion institutions versus the $50 million guys. That's a bit of an apple to oranges exercise that I think a lot of us are pretty tired of. What I'm referring to is of the credit unions in your size, in your asset tier that we'll break down in this presentation, what separated all the ones pulling ahead from the ones that are just standing still? And there were three answers, three moves that we're going to spend some time on today. And I think all of these are things that you can exit out of this browser tab and actually act on come Monday morning. And that's the goal for today. Walk you guys through exactly what the data says and what you guys can do with it. So let's get into it. But first, 30 seconds on why you should listen to me. I run new verticals and strategic accounts here at BlastPoint, which is basically a fancy way of saying I spend most of my time talking to credit union teams about how to turn the data they already have sitting in their internal system into something you guys can actually use, whether that be actual primary financial relationships, actual growth, all of this without just going out and buying new accounts to hit a specific number. So at this point, I've had the chance to work with hundreds of different credit unions, and the models in these case studies that I'm going to walk through with you guys today are the exact same ones that we would run against your book. So this isn't theoretical. Every number on these slides I've watched play out in a real member file. All right, so here's the roadmap for the next 45 minutes. First, I'm going to show you the growth gap, what the fastest growing credit unions did in Q1 of 2026 versus their peers, their own size. And then we'll get into the spread and the averages and what that tends to hide underneath what just might show up on the balance sheet. Then we'll get into the three moves themselves. Move one is going to be all about growing membership and balances together. This is the habit that the fastest growing credit unions typically share. And it turns out the vast majority of institutions, about 80% of them, miss the mark on this. Move two, activating the members that you already have. For a lot of credit unions, I think you'll find that your safest growth this year may already be sitting inside of the books. And move three, evaluating the budget you already have. What you'll find later in this webinar is that the winners in this data didn't spend more, they simply aimed better. So by the end of all this, you guys will walk away with three very specific questions that you can literally go pressure test on your own institutions after you get off of here today. We'll do a live Q&A on whatever's on your mind, and I'll show you a way to get a free read on where you guys stack up against your peers. So let's start with the benchmark, because I think most of you know your own growth numbers, but you probably don't know how that stacks up against your actual peer group. So how did the fastest growing credit unions actually separate from peers of their own size? And what's the spread that the industry averages tend to hide? Let's look at the top line numbers here first. So the first thing that jumped out to us immediately, if you just look at industry averages, everything looks fine, pretty steady, but overall just fine. But when you dig a little deeper, these averages actually hide a story that I think is worth sharing. So we essentially split these credit unions between ones that beat their peer group of the same asset size versus the ones that didn't. Member growth, right? The ones that beat their peers grew members by, on average, 1.5%. The ones that didn't were actually negative, down the inverse of that at 1.5%. So this is a strong signal that these are two totally different industries, right? Not necessarily just a gap. Like one is growing while the other one's shrinking. For asset growth, same story. Winners at plus 7.1%. Everyone else just barely over 1.5%. And deposits, this is the one that I would encourage you all to sit with for a minute. Institutions who beat their peer group on membership grew deposits by, on average, 4%. And the ones that didn't, less than 1%. That's basically a 5 times the deposit growth just by being in the group that was also growing their membership. So here's something that I've noticed when I'm sitting across the table with dozens of other leadership teams who are really looking at their own version of this exact benchmark. What I tend to find is that almost everybody over indexes on the absolute number and tends to under index on the peer adjusted ones. I had a CFO who once told me almost verbatim that they grew deposits by 3% last year. Like in his mind, they were fine. And on its own, sure, like that's great positive growth, but their actual peer group grew by 5%. So relative to the field that they were running in, they were actually losing ground while it felt internally like it was a pretty significant win for them. And I think oftentimes that's the trap with the absolute number. If you look at that in isolation, it feels good, but it almost tells you nothing in context unless you're looking at the broader comparisons of credit unions in your tier and in your area. So what's actually driving that split underneath those averages? What we found are 3 measures that do almost all of the work. And each one here anchors on the moves that we're going to be spending the rest of the day on. First, it's all about new membership growth alongside AMR growth. That's average member relationship, basically how deep the average relationship runs across all of your loans and shares. Growing both at once is move 1. And I think what you'll find is it's notoriously hard for most credit unions to do both simultaneously. Second is the strength of that AMR growth specifically. Is it actually coming from deepening relationships, or is it something else that's driving it like beneath the surface? So that's question 2, and I think it's the one that's going to surprise some of you the most. And then third, return on your marketing dollars. Not how much you guys are spending specifically, but what you're getting back on that spend. That's move 3, and it might be the most, I would say, counterintuitive finding in this whole analysis. So before moving on, here's the one sentence that I want to leave on this slide. Your members already trust you with your money, right? The leaders in this data simply figured out how to turn that trust into primary relationships. Nobody's out here, at least from what I've seen, inventing new members from nothing. The winners are working their relationships already sitting in their core. And one thing that I will say from sitting across the table with a lot of C-suites and different analytics teams or marketing folks on exactly this type of data is almost nobody argues with these 3 measures once they see them laid out in front of them. The pushback that I typically get, rather than like, this is wrong, is, okay, but which one do we go fix first? Because maybe we don't have the bandwidth to run all 3 of these initiatives at once. And I think that's a totally valid question. And it's exactly why we built the 3 take-home questions that you'll get later in this deck. So you're not guessing which move to prioritize. You're really pulling the answer out of your own numbers. So before digging into the 3 moves individually, just want to show you one more macro number because I think it kind of does a good job of reframing why this actually matters beyond just quarterly growth metrics. So this is the slide that honestly changes the tone of the room a little bit sometimes whenever I show it live, because credit union consolidation is really accelerating, right? There's 450 fewer credit unions now than there were just 3 years ago. And here's who's exposed. 58% of all credit unions are under $100 million in assets. That's the majority of the industry by count, but collectively they hold only 3% of industry averages. Meanwhile, the top 80% of assets sit with the biggest 10% of institutions, the ones that are well over $1 billion. And it makes sense right? I'm not showing this to scare anybody, but mainly to just over communicate that small and steady isn't really a stable place to be anymore, right? Steady's a merger trajectory if you're really small. And the three moves we're going to walk through are, in a very real sense, what keeps you on the right side of that consolidation line. Now, I will tell you that this slide comes up in almost every conversation that I've had with a credit union leader this year in one form or another. To give you an example, I was talking to a CEO of a sub $250 million shop who just flatly told me that they're not trying to be the biggest. What they're trying to do is not be the smallest one left standing. I think that's the mindset shift that I'd encourage in this room. Like, I don't think of this as necessarily a growth slide, as more of it is of relevance slide. Like, how is growth going to help you stay in the conversation at all? Okay, so let's get into the three moves. The first one is all about growing membership and balances together, both at once, measured against your own peer group. Only about 1 in 5 credit unions actually clear that bar. But let's look at why that matters so much based on what the data says. So here's the payoff for roughly 1 in 5 who are making traction on both of these metrics. Credit unions growing both new membership and what we call AMR, again, average member relationship, post a median return on assets of 0.85% against their peer group. The ones that don't, 0.59%. So why is this so hard? I would say it's because these two things actually pull against each other in practice. Because if you add a member who never really moves anything meaningful over, maybe they haven't set up that direct deposit, they haven't opened up a second product, like, you've essentially added a name to the count, but you've diluted your average balance per member. And then there's a real mechanism behind that, right? By the way, this isn't just us speculating. Capital Performance Group research found that a member who never moves a direct deposit to you is 4 to 7 times more likely to attrite. And separately, Zafin looked over 3,000 live account opening offers in the market last year and found that roughly 40% of them, 40, were literally relationships deepening that weren't built in at all, right? So like, the industry in a lot of cases is, I think, structurally set up to add members without really deepening those relationships. And then I have a lot of credit unions who are asking why the AMR number doesn't move. So I want to make this concrete, because a member who, I would say, never moves a direct deposit can sound abstract until you actually pulled that list yourself. So, after sitting with leadership teams who ran this exact query, being they flagged every member who opened an account in, let's say, the last 18 months and never set up a recurring deposit with them. And that number almost always comes in bigger than what leadership was expecting going in. I had one executive team who guessed that it would be in the single digits as a share of new accounts, when in reality it came back closer to a third. And like, that gap between what leadership had assumed and what was actually happening is what the member file actually shows. It's honestly where a lot of the opportunity in move one, I think, is sitting. So what does this actually look like when a credit union pulls it off? Let me show you a real example. This is a Midwest credit union that we worked with. They were essentially able to uncover hidden opportunities inside their own community with pointed, targeted outreach at those specific members. Ended up for them $26 million of new business and 4% membership growth overall, all out of a single campaign. So 16 million deposits, 10 million in loans. And the thing that made it work, it wasn't necessarily a flashier budget, or like going to ask for a bigger budget, or like having a flashier product offering. It was simply by identifying which existing members that they had unmet potential, right? People who were already in the door, already trusting them with some other relationships, who had room to deepen. And deposits, loans, and memberships essentially moved together because the targeting was built to move them together, instead of running a membership campaign in one silo and a deposit campaign in another. And I will tell you that what I think is the transferable part for you guys about this campaign, because there is a subtle shift, right? This credit union didn't build 3 separate lists. a deposit list, loans or membership list. They essentially built one based on which existing members, in this case, had unmet potential. And then the messaging, of course, would vary based on the objective they were looking to solve. Because if you have new members who don't really have those relationships with you, I think that message should come across a little bit differently than the ones who are already in the door. But the difference is that rather than having three campaigns competing for the exact same like prioritization and marketing calendar and budget, they were really able to get this done with one campaign doing three jobs at once, just tweaking the approach a little bit for each. And I think that's the takeaway for move one, right? I would encourage everyone here to, not treat member growth and AMR as their two completely different department problems. The credit unions who are getting this right are running one campaign on the same members, not several that are competing for the same budget. So now let's talk about move two. And I think for a lot of you, this is the one that's going to feel a little bit personal because it's probably sitting inside your own scorecard right now. So we talk about activating the members that you already have in a large share of credit unions, right? That average member relationship is rising while membership is actually falling. And I want to, biggest takeaway, if I can be really direct about something on this slide, is that those at-risk relationships aren't out there somewhere. A lot of them are still sitting just in your books and just waiting to essentially be activated. But there's a reason why this is so easy to miss. So here's the question that I want you guys to actually ask yourself whenever you get back to your desk. Is AMR up because your balances grew or because your members left? Because on a dashboard, those might look identical, right? Relationship depth, the underlying number behind AMR is just like balances, of course, divided by members. And sorry, I think I skipped ahead a little bit. But if that ratio goes up, right, if members leave, that denominator is obviously going to shrink. The ratio then goes up, and then the flip side of that is like if we want to look at members, credit unions in this cohort, the largest single group in the industry, 40% of credit unions had a relationship depth that was up just over 5% year over year. It sounds great, but membership was actually down about 2.8% year over year in that exact same group. And their median ROA sits at 0.63% against 0.83% for the credit unions who were actually growing both simultaneously. So that 0.63 isn't a bad number, right? It's not necessarily alarming to a lot of executives, but I think that's exactly the problem, right? 0.63 reads a little soft, maybe not as urgent, which my take is that's why 40% of credit unions just aren't acting on it, because it's not an alarming number. It's more of a comfortable one, I think, for a lot of shops that I'm talking to. And it gets more specific than that. In that 40%, 13.1% of all credit unions are actually shrinking on every front, meaning membership is down, balances are down, and yet their ratio still climbs because both numbers are falling and the denominator is falling faster. That's why 1 in 3 of the whole kind of 40% group is falling to that. So we could look at this as a depth looks fine while membership is softening problem for I would say a meaningful chunk of that cohort. The underlying business is contracting and the dashboard is really telling them something obvious, something opposite. Rivel also backs up that research onto why this is so easy to miss. And they found that low attrition has basically stopped being a useful sign of health because a lot of members who are disengaging can do it quietly, right? They might stop using you as their primary financial institution long before they ever walk in and formally close an account. So among their, I would say, most vulnerable segment of high income members, specifically 40% had effectively already left without ever closing an account officially. And I think this is the slide where I've had some of the most uncomfortable conversations with credit union leaders, is because the instinct is when AMR is rising to take a little bit of a victory lap. I had a VP of marketing told me almost word for word, like, our numbers have never been better. when at the same time, um, their membership was quietly declining, right? And I don't want to bring that up to embarrass anybody. It's, more so because the dashboard genuinely doesn't distinguish between those two stories. And if nobody at the credit union is asking that follow-up question, it's a very comfortable blind spot to sit in for a few quarters running. So what does this actually look like in practice? Let me show you a real example. So this is a regional credit union that replaced its manual member lists with more intent-driven targeting to a seasonal auto refi offer. Now, instead of pulling a generic list of everyone who might qualify for this offer, they used behavioral segmentation to find the existing members who were actually most likely to act on it. And the result for them was a 50% open rate against a 30% benchmark and 4 times the click-through rate of their usual campaigns. I should also add that they hit a positive ROI across these two campaigns in just 17 business days. But what I want you guys to sit with here is that none of these members that they were activating were new. Every single one of them was already on the books. They were already a member and trusting this institution with some piece of their financial life. So the only thing really that changed was how precisely this credit union could identify which of those existing members had unmet needs for this specific offer at that specific moment. And I think that's an honest lesson from Move 2, right? The growth is often sitting in your member file. You don't necessarily need a bigger acquisition budget to find it. What I often find for credit unions who come to us is a sharper way of asking your existing data who is actually ready to act on is enough to get what you need out of your existing membership base. Okay, so moving on to Move 3, and this is the one that I think will surprise a lot of you because it I would say cuts against the instinct that growth requires a bigger check. So Move 3 is all about evaluating your budget that you already have. Above $100 million asset credit unions, marketing spend, what we'll get into in the next slide, does not predict which credit unions grew. So here's the split that I think is the single clearest number in this whole analysis. We took all credit unions and essentially sorted them two ways. Did they spend above their peer median on marketing? And did they grow above their peer median? So institutions that spent less and still grew, over 1,000 of them, ended up spending about $340 million combined spend. And among all of them, they added over 1 million members collectively. Looking at the other side of the coin, institutions that spent more didn't necessarily grow, right? Of another roughly equal group, over $1.3 billion combined spend, nearly 4 times the money, and membership actually declined. So less than half the money produced 2 million more members net than the group spending the most. I think this is a pretty strong indicator that the budget genuinely just wasn't the factor that mattered most here. So if you look at marketing intensity by asset size, right, basis points of assets spent on marketing at 100 million to 500 million, winners and non-winners spent exactly the same, 10.3 versus 10.3 basis points, identical. Same story at 500 million to 1 billion, and again from a billion up. In 4 of 6 of those size groups, spend just wasn't the story. Right now, there is one row on this table that is worth pointing out on your own. The credit unions who fell under the 100 million asset threshold, right? The credit unions here that cleared the bar actually spent more versus the ones that didn't, 5.4 versus the 3.1 basis point. So for that specific group, the read here is a little bit different. I would say it's less about aim and more about simply having enough in the tank to compete at all. But for the vast majority of the industry, if you're sitting above $100 million, spend just isn't what separates those two groups. I've sat in on enough of these budget conversations to know like how the usual version typically goes. a marketing leader or someone in analytics or member experience will, go into a board meeting while growth is flat, and the ask is almost always for more spend. Like I totally get that instinct. It just seems like it's the easiest lever to kind of pull that feels most within your control. But as you can see in basically every one of these conversations where we've had sat down and looked at the data together, the honest finding is that what we found is matched on this slide. The credit unions that are actually growing aren't outspending anybody. So, if you're the one like walking into that board meeting, my honest advice is that the stronger case is like, let me show you where the money we already have is actually going. Of course, precision and being more hyper focused on the members that you're targeting definitely helps with that. So let's make that concrete with one more real world example. This is based on a case study we did with a Northeast credit union where they used our advanced analytics and member segmentation, to essentially point a wallet share campaign at the right demographic and the right behaviors. On the exact same budget as before, the result, 92% higher click-through rate, 70% lower cost on that exact same email campaign. So the exact same dollars, but completely different results because the aim changed, right? Not the size of the check. None of what these big winning credit unions, or not big, but what of these winning credit unions are doing requires a more robust or fatter marketing budget. What we typically find is that it requires discipline to point the budget in the direction of the right members, the ones who know are likely to take up those specific products to deepen member relationships. And that's a pattern that I've seen kind of repeat often enough that, it's closer to a rule of thumb at this point, right? If the campaign that outperforms almost always, traces back to a sharper list. So now that we've got the three moves, these three levers, let's make it useful for you guys specifically. Here are the three questions that I'd encourage you to go back and answer about your own institution. Starting this week, you can do that using the data that you already have. Question one, year over year, quarter over quarter, are your membership growth and your AMR growth both exceeding the median for credit unions your size? Remember, it's only about 21% that are clearing both of those bars, and that holds true in every single asset group. So size isn't necessarily the distinguishing factor either way. Question two, pull every member by month since they last opened anything, whether it be a new product, a new account, anything. And on the tail of that report, the members way out past the median, right? So that's your reactivation list. If you recall from a couple of slides ago, again, 40% of the industry has AMR climbing while membership falls. And that's the group that this question is built to catch. Question three, of your existing marketing spend last year, what share went to existing members versus new member acquisition? Again, $100 million to $500 million credit unions and asset size, winners and everyone else spent identically the same. So the split matters more than just the total. So these three questions aren't going to tell you which move to do first. That all depends on what your own numbers suggest. But what they will tell you is where your biggest gap actually is, and honestly, super helpful instead of just guessing. So here's the thing. Now that you have kind of the macro picture on the industry, what matters most is that you don't exactly yet know where your own institution lands against others in your actual peer group. So here's what we'll do. Let's sit down for 20 minutes. You go through your core metrics together, pull benchmark, show you exactly where you land against your peers, your size. And, at the end of that conversation, you should walk away knowing exactly where you stand. Really no prep required on your end. There's a QR code that Jeff, I don't know if you want to drop in the chat, but I do believe it's on the next slide here if anyone wants to grab a time. Now, before I answer some questions, just one quick summary and a couple of ways to keep going after today, just beyond maybe listening back to this webinar recording. First, you can look up your own credit union directly on the credit union scorecard. So that's cuscorecard.blastpoint.com. We should have a link going out after this to those of you who came if anyone wants to check it out. But it's essentially got 12 plus performance signatures and it ranks you against your actual peer credit unions, free for you guys to access anytime you want. Second, if you want to go a layer deeper, specifically on the marketing side, where your spend is going and whether it's actually pointed at the right members, we can help you pull those numbers together. Or if you bring your own, like we'll spend 20 minutes walking through a marketing performance assessment one-on-one. So if it's interesting at all, scan the QR code on the screen or grab a link in the chat, either way. With that, Jess, I'm going to pass things back over to you because I know we've got some time now for a Q&A portion here.
Yeah, thank you, Seth. That was great. The first question that we have is, how do you distinguish a member who will respond to a CD promotion from one who's, ready to go primary?
Yes. So, good question because I think both of those are really two different objectives. Um, if I'm trying to fill a CD campaign, the first question that I would be asking is who's most likely to respond to this product, right? That's more of a product propensity question. But if I'm trying to build long-term growth, I'm asking a slightly different one. Who's most likely to make us their primary financial institution? That's a relationship question. Like those aren't always the same member. So, someone who's shopping for a CD might be more rate sensitive. They may move money in today and move it back out, 6 or 12 months from now. There's absolutely a place for that if your objective is funding or liquidity. And, not to throw shade at that CDs, I think like, a lot of members, that's how they choose to transact nowadays. But what a lot of credit unions aren't doing, and what I'll kind of get into, kind of rounding out this answer is identifying the low hanging fruits within those members who are adopting a CD who are likely to deepen those relationships, right? There's no silver bullet, but I think if you're trying to grow your business over the next 5 years, you're looking for members who are likely to deepen those relationships, right? Maybe they're just now starting a new job and haven't moved to direct deposit yet. Maybe they have a loan somewhere else, but they're already banking with you, or they have a checking account but haven't yet adopted another product. Like these are the kinds of opportunities that create much more lifetime value for your members. I think one of the themes throughout the webinar today is that the fastest growing credit unions are identifying that right next conversation for each member, right? And sometimes that's a CD, but sometimes it's also a checking account or a mortgage or getting them to do their payroll with you. So I think the better question to be asking is, what's the highest value next step for this specific member? Because what I typically see at a lot of credit unions who are thinking that way is their engagement strategy. To get that strategy much more intentional, the ones who are doing it right are building relationships, right? Not just generating kind of product opens. And so over time, that's really what ultimately drives the stronger deposits and gets those deeper relationships and helps with healthier growth if you're able to lean not less on those rate driven deposits. Again, I think those are important for any institution, but specifically with the ones who are likely to deepen relationships past a deposit that's frankly expensive for the credit union, or one that once that kind of CD rolls over, they're likely to just walk out the door because that's the only thing that brought them into the institution in the first place.
Awesome. Thank you for that. The next question we have from one of our attendees is, I think it was back on move two. Was this deposit growth fueled by, CD promotion or standard products?
So a mix of both, right? I think we can all agree that CDs are a little bit of an easier kind of egg to chase, but that case study specifically is a mix of CDs as well as core deposit growth because ultimately, again, I've seen some credit unions run some very successful CD campaigns, but often where they are having challenges getting those more core organic deposit growth. So that case study specifically, which Jess, maybe I can get the name after. I'm happy to send it one-on-one for you to do some digging into that yourself. But it is a mix of both because we understand that, like, of course, the rate-driven deposits are important, but what I'm typically hearing from other credit unions is those core checking account growth deposits are more valuable to the credit union long term.
Awesome. Thank you. Another one that just came in and it is, in your experience, what is the most effective product to create or offer to generate the highest AMR with the lowest marketing cost? Indirect, direct auto loan, checking account, CD, etc.
Yeah, that's a really good question. Um, talk like I have yet to meet, well, I won't say that, but very few credit unions who struggle like getting more indirect like loans, right? I think that for the challenge for a lot of credit unions who that I'm seeing specifically who have like a high indirect auto loan portfolio, they're getting those members in the door, but same kind of thing with the CD promotions that we were talking about, or the CD question we were talking about earlier. How do we get these members more entrenched with our credit union versus, for the indirect folks, they oftentimes don't even know that they're a member of your credit union. And you really have like not the first 90 days once they're brought on at your credit union to deepen those relationships. Otherwise, the chances of them adopting something else really falls off significantly. I've got data points to back that statement up. But as far as specific products, what we're finding, and I've got a case study that didn't make its way into this webinar. Checking accounts. I think checking accounts, again, going back to those core deposit growth, if you're able to identify in your, let's say you have a big indirect auto loan portfolio, the top few thousand across your member base who are likely to adopt that product, that's usually a pretty quick win for a lot of credit unions. I would also round it out by saying credit cards. The checking accounts and credit cards are two big products that we typically see credit unions are rolling out to market, or at least trying to get more adoption of, and they typically see a lot of success with those.
Awesome. Thank you. Another question is, the budget for any CU in a smaller market will go much further than a budget in a CU in a larger market. Was this considered when we were taking all of this into account?
Yeah. So as far as I agree with you, right? Because I think what's important to note is that whenever you have like these models and you're trying to figure out like who is the members that I should be engaging with, that approach is going to look a lot different for a credit union in rural Texas, where I had a director of marketing once tell me we have literally more cows than people in our town, versus a credit union that's in New York City, and so they're obviously more densely populated um, with people. So I do agree with that statement, and I'd have to unpack the numbers a little bit more to see exactly how that plays into that. But I do agree that especially if you're a smaller shop, what I typically find is whenever you're in those more like rural or areas where there's not a lot of people, you typically have a pretty good one-on-one relationship with your members already.
Yeah, one note that I actually just got from our team is that, we never compare raw budgets. We measure marketing as a share of assets, and we compare each credit union only against others of its own size. So the next question that we have for you, Seth, is, you talked about reactivating existing members before acquiring new ones. Why is that?
One of the things that jumped out to us in that analysis. Again, over 40% of credit unions are, again, losing members while their relationship depth is increasing. So at a first glance, that sounds like good news, but the relationship depth is um, often calculated, loans and shares divided by members. So if members are leaving, that ratio can actually improve, even though the credit union is shrinking. I think that's why it's often such an easy metric to misread. What that tells me is that there's a pretty good chance that there's a lot of credit unions that have members already on the books, again, who have never become those primary relationships. Maybe they opened up a savings account years ago, or they financed one loan and never came back. Those members have already raised their hand and said, I trust you enough to do business with you. So that's why I recommend, before spending money trying to convince complete strangers to become members, it's often worth asking whether there's existing relationships that simply haven't reached their full potential yet. And that's not to say that member acquisition is not important, but I think reactivation is one of the quickest ways to generate growth, because you're starting with, again, trust that's already been established with your members.
Yeah, for sure. It's always going to be cheaper to keep the people that you have versus, acquiring a new one. Um, If we are already resource constrained, which of these three moves would you tell us to tackle first, and which one do you think can wait?
So I think the answer is like let your own data decide, right? I think every credit union has different constraints. Um, some have an acquisition problem, others have plenty of members but shallow relationships. Others are spending efficiently but essentially aiming it at the wrong type of member. So, like if I were to walk into a credit union tomorrow, the first thing I'd want to understand is where the biggest gap actually sits. Like, are we adding members but not growing balances? Maybe we're doing a good job of retaining members, but we're not doing a good job of making them primary relationships. Are we marketing to everyone in sort of like a blanketed approach instead of the members that we know have the highest likelihood to take up this specific product? I think once you answer those questions, the priorities usually become pretty obvious. But the good news, those aren't three completely separate initiatives. I think that they essentially reinforce each other, right? Because when you identify the right members to reactivate, you're often also deepening relationships, right? When you acquire younger members who are likely to become primary, you're helping solve the aging member problem, which is something that I think a lot of credit unions are dealing with right now. I mean, I live in Florida, so retiree country, definitely a problem for a lot of credit unions here. So, like the point, like it's not necessarily to boil the ocean, rather than starting with the opportunity that's most likely to move the needle for your institution. But again, all of that starts with like, what is your data saying?
Yeah, that totally makes sense. The last question that we have is the three moves all sound like they lean on segmentation and data. What's the actual lift for a team like ours to go do this? Are we talking like a quarter, a year, or a new hire entirely?
Yeah. Um, so I think one of the biggest misconceptions in our industry is exactly that, because a lot of credit unions that from what I hear, talking with so many of them, that they already have a ton of data, right? And that's not really the challenge, is access to data. You guys already have a ton of data that's probably very messy and fragmented and siloed. But what I do see the challenge being is turning that data into decisions that your teams can confidently act on. So I would almost think about it this way. Let's say you have 50,000 members. Like, how do you know where to start? Like, how do you know which 2,000 of them are likely to take up a checking account, or are likely to take up a HELOC or a mortgage, or, um, you know, things that are going to make them help you capture more of that wallet share? Like, how do you know which members are drifting away before they actually close their accounts? Um, I think these are the questions that, someone can't really answer by like manually sorting through an Excel sheet or like looking at a Power BI dashboard. Because, historically that's been the trade-off, right? Either you build a team of analysts to answer those questions, or your marketing team, oftentimes defaults to more broad campaigns because they're oftentimes practical, which I totally get. But what I will say is what I've seen change over the last few years is that credit unions don't have to choose between those two extremes, right? You can use data to narrow down 50,000 members to a few hundred or a few thousand who actually warrant attention. And then your marketing team, of course, still does its stuff, what they're already really good at, building those campaigns, building those relationships. So I think the opportunity here is really helping marketing know where to point its efforts. Because when again, who has the highest likelihood of responding, who's most at risk of attrition, or who's most likely to deepen their relationship, what it comes down to is every email, every call, every dollar that you're spending in your budget, becomes much more intentional.
Awesome. Thanks, Seth. I think that is all of the questions that we have.
Awesome. Great engagement. So I don't want the conversation to stop here. Again, feel free to scan this QR code if you haven't already. I think, Jess, we're sending out a recording to everyone, post meeting
Yes.
or post webinar. So if anyone wants to keep the conversation going, you've got my contact information. Please reach out. I'd love to hear from you guys. Thanks everyone for joining. Have a great weekend.